Hi, good afternoon. Welcome to MF Corner. I'm Sumera Abdi, and before we get started with today's show, let me just offer my heartfelt condolences to those who have lost their family members because of the ongoing second wave of COVID. And, for those, everybody else, I can just request that please stay at home to the extent possible. And if you must venture out, please wear a double mask. And whoever is eligible for vaccine, as and when they can get it, please do so. We're going to get started with answering queries, but our contact information will be flashing for you at the top of the screen. So if anybody has queries related to the impact of COVID on their finances, we'll be very, very happy to help you as well. Joining in today to answer the viewers' queries is Shweta Rajani of Anand Rathi Wealth and Nikhil Kothari of Etika Wealth. Good afternoon to both of you, and thanks very much. Next up, we have a caller who's connected with us from Adelaide in Australia. Naren Sherry is on the line. Hi, Naren. Go ahead. How can we help you?
Hi. My question is very simple. I just wanted to know if somebody has got a corpus of about 30 lakh rupees, how does one invest? Because in mutual funds, don't want to get into mutual funds straight away into the equity funds I'm talking about. So what would be the best way to get into mutual funds for equity? And so my suggestion or my thoughts were to get into liquid funds or debt funds, and then put like 1 lakh rupees every month in a SIP mode into the equity mutual funds. That's what I was thinking. What would be the most suggested way as per you?
All right, Naren. Well, this systematic transfer plan that you have thought of seems the logical way to go, but I'm going to leave it to Shweta to answer it. Shweta, go ahead.
Naren, the first thing I would want to make clear is that whenever you start your investment planning, the first thing that you need to understand is what's your investment horizon, your risk profile, and what's the return that you are targeting. That leads to the next decision of your asset allocation. So you decide how much of the money can go into equity and how much can go into debt, which will help you achieve this objective. Now, what I understand is you've taken care of the first part. So that's where you are now specifically focusing on the equity portion of your portfolio. If not, then just a suggestion here that if you have a 3 to 5 year horizon and a moderate risk profile for your overall portfolio also, generally you can have 65 to 70% in equity and the residual in debt. Now, coming to equity, the choice that you've chosen of equity funds is a good choice. Because purely investing in stocks, again, can be more volatile and needs far more knowledge and time to be spent. So leaving it to a professional fund manager is a good decision to be taken. The third point here is of trying to benefit from the volatility in market, if there is any, which in the given time period is a possibility that you could notice some amount of volatile situation. So an STP, which is systematic transfer plan, is a good option to do. My suggestion here would be that you can have a weekly or a fortnightly STP, and over the next 2-3 months, this quantum, whether it is the entire 30 lakh or if you want to split and put 20 lakhs in equity and balance in debt, can be equally split into these 8 weeks or 8 fortnights, or you can do it on a weekly basis and go ahead and deploy. What you should do for an STP is you should put it in a low duration fund of an AMC where you want to put the equity fund. So if you want to put it in a Mirai Asset Large Cap Fund, you put it in the Mirai Low Duration Fund, and from there on a weekly or a fortnightly basis do your transfers. The benefit of doing this is that your low duration funds can give you approximately a 3.5-4% yield. As compared to a liquid fund where you would expect a 2.5%, or your savings bank, which would give you a 2.5%. So you, even for the debt portion, you are making it a little more efficient. From fund standpoint, my suggestion here would be that you have a mix of large and mid cap funds in the portfolio. So you can have a Mirai Asset Large Cap Fund, an Axis Blue Chip Fund, a Kotak Emerging Equity Fund, which is mid cap oriented, SBI Focus Fund, which is, again, it has large and mid cap both in their portfolio, as well as Canada Flexi Cap Fund. So all these are funds which are managed by fund managers who are good in terms of their stock picking. highly rated in the industry. They have ensured consistency in their returns. Risks are very well managed.
Up next, I've got a query on Twitter, and speaking of winding up of schemes, SD Ashtaputre says that UTI didn't pay us anything while winding up their MIP 2000 scheme. They skipped the income distribution for the third and fourth year. How come? Shweta?
Yes. So UTI 2000 was launched in 2000. It was an MIP scheme with a maturity of March 2005. Most of the investments were on the debt side, and for the first year, they had assured a payment of around 9.5-10%. And for the following 4 years, the distribution rate was to be decided basis the income they would have earned. For the first and the second year, they paid out in the range of 9.5 to 10%. At the beginning of the third year, they did mention that there would be no income distribution, but towards the end of the year, in the last 2 months, they had made some income, and therefore the payout was a 3% per annum. So there was some payout. It wasn't that there was no payout, but a very small quantum was paid. Also, fourth year, roughly, there was a similar 3% odd paid. And at somewhere around August 2004, which is little 6 to 9 months before the original maturity date, they closed the MIB because of volatility in the market, which led to their incomes dropping. When they closed out, that was on 31st of July 2004. For the 4 months of April to July, they had again announced a payout of 3.5% per annum. Plus the principal, which was assured, was paid back to the investors. So the payout was made. Probably if you've missed out, then we'll have to write back to UTI to figure out where did you miss out getting the payment.
Okay, so Mr. Ashtaputre, in case you have not received, the last payment that was made out, please do reach out to UTI, and if you still face troubles, we'll be happy to take up your query again. Parth Shah sent us an email. Now, he's a young investor, all of 21 years old, and with his stipend income, he has started his investment journey, investing 1,500 rupees each in the Nifty 50 index fund and an active flexi cap fund. He's not named it. Another 500 rupees in the S&P 500 index fund. Now, he wants advice on the changes if required. Now, Shweta, I'm going to leave the changes to you, but I want to just say that, in this whole active passive debate that's going on, there's this trend that seems to be emerging that a lot of the younger investors are now looking more at passive products. And, even if you look at the portfolio sent in by Parth, it is, 2/3 in passive in an index fund. So, Shweta, what would you recommend? Does he continue like this? Or do you think for now, having a predominant passive portfolio is not the right way to go?
So, Smara, firstly, I would like to congratulate Parth that so early he's got into the discipline of investing. Parth, here, I would like to tell you two things. That when we look at data for mutual funds, of mutual fund industry tends to outperform the index. Over the last 10 years, that's been the track record. Even if I see these last 4 months, there would be 80% of the mutual fund universe, which is outperforming an index. So clearly there is merit in staying invested in an active fund instead of an index fund. The average outperformance that you can expect from a large cap fund versus a Nifty index can be in the range of 1.5-2%. Second is you're just 21 years and you have a longer time frame. So when you are investing in funds, you can have combination of large and mid cap in your portfolio. Now, mid cap again tends to, over a longer time period, outperform large caps by around 4-5%. And given where the current valuations are, what we are expecting in terms of earnings from mid cap companies versus large cap companies, to an extent of 40% is what you can have as mid cap in your portfolio. So my recommendation would be that consider active funds instead of the index funds that you have. Within active funds, you can do an SIP in funds like a Mirai large cap fund, a Kotak Equity Opportunities Fund, and a DSP Mid Cap Fund. So one is large cap, one is mid cap, and the third one is a large and mid cap fund. If you look at the past track record of these funds also for a holding period of 5-7 years, you would see that if index has delivered a 12.5% return, these funds on an average would have delivered 15% return. And as the time period increases, the alpha, as we call it, or the outperformance of active funds over the benchmark also goes on increasing. So that's, my recommendation.
All right, Shweta, fair enough. Makes sense. Mr. M. Lalwani has written in on Twitter. He wants some investment options for senior citizens where he can invest for regular income. Shweta, once again, this circles back to debt funds, or do you think there could be, is there another alternative that's more feasible?
Yes, Sumaira. So, Mr. Lalwani, for a senior citizen looking at regular income, there are various options which are available. You will have your senior citizen savings scheme, which offers around 7.4%, and it makes a quarterly payout. You have your 7.15% RBI bonds, which give a half-yearly payout. Then you have your normal fixed deposits. You have your debt funds. Fixed deposits are offering around 5% odd. And debt funds, you can expect around a 6% odd return from a high-quality portfolio. So good credit quality portfolio. I'll just tell you the difference between the four options. Fixed deposits, the RBI bond, as well as the senior citizen schemes would be taxed to you at your marginal tax rate, irrespective of the holding period. So if your senior citizen is giving you 7.4% post-tax, it would end up giving you a 5%. The other options would be further lower than 5% on post-tax. The debt funds offer you an advantage that if you stay invested for more than 3 years, then it's taxed to you as long-term capital gain. And the tax rate is 20% post-indexation. So your effective tax rate comes down to around 10% that you would pay. Moreover, debt funds give you an option of systematic withdrawal. So you can choose the frequency at which you want your withdrawals and the quantum that you want to withdraw. Plus, when you withdraw, it becomes a little more tax efficient because here again, even though it's taxed at the marginal tax rate because it's short-term capital gain, when you withdraw, there's a component of principal and growth both as well. Secondly, from a liquidity standpoint, if you see the first three options of RBI bond or the senior citizen savings scheme, they have a very stringent lock-in period. So your RBI bonds are for 7 years. You cannot withdraw before that. Your senior citizen savings schemes are for 5 years lock-in. Debt funds give you complete liquidity, flexibility, even in this case. So you've invested today, after a month, you need to withdraw for any emergency. That option is also available to you. So I would be in favor of debt funds because of the tax advantage as well as the option to liquidate in case I need for any emergency. And within the debt funds, if I have to give some names, I would look at something like an HDFC Banking and PSU debt fund, or SBI Medium Duration Fund, or ICICI All Senior Bond Fund. So these are all high quality portfolios which are investing primarily in government papers, PSUs, high quality AAAs. So that would be the various options and my recommendation from that.
All right, Shweta, Nikhil, thanks very much for joining in and for advising our viewers. We value your time and we hope that you, your colleagues and your families stay safe. Thanks very much indeed. With that, we'll wind up on MF Corner for today. Do keep sending us your questions. We'll be very, very happy to help you in any way we can. Thanks for watching.